Hello and welcome to the Business Standard Morning Show. I'm Nazia Iqbal and here's a look at the stories for the day.
रामू, दो चाय दे यार।
अरे नहीं यार, एक चाय कॉफी।
We Indians disagree on everything, but we agree. SBI is the banker to every Indian.
SBI का home loan, I agree with you.
SBI is the banker to every Indian.
At least 300 educators and 700 other employees of Edtech firm Unacademy were shown the door recently. The startup didn't give any reason, but experts believe that it was trying to control its cash burn after aggressively hiring to meet ambitious targets. So what is the road ahead for India's edtech sector post-pandemic? Watch our next report to know more.
Move fast and break things was Mark Zuckerberg's motto for Facebook in its early days. He said that companies must not lose opportunities by moving slow, and that mistakes should be forgiven as you take risky bets. While many founders lived by the slogan, we can say from recent experience that it may not be suitable for the edtech industry. In the quest for hyper-growth, Indian edtech companies have moved fast, disrupting the education sector. Unacademy, India's second largest edtech firm after Byju's, has reportedly laid off 1,000 employees over the past few weeks in a cost-cutting drive. Founded in 2015 as a YouTube channel by Gaurav Munjal, Roman Saini and Hamish Singh, Unacademy is currently valued at $3.4 billion. The startup's last funding round was in August 2021 when it raised $440 million. So far, Unacademy has raised $858 million in funding, while the total funding for its bigger rival Byju's, which is also India's most valuable startup, is at a whopping $5 billion. Both of them have gobbled up smaller startups with niche offerings. They have each acquired at least a dozen startups. Byju's spent almost $2.5 billion on acquisitions last year. Its co-founder and CEO, Baiju Ravindran, made a personal investment of $400 million in the company's $800 million round last month, which catapulted its valuation to $22 billion. The move was reportedly part of the company's strategy to show the founders' confidence in the firm and help shore up investor interest at a time when the valuations are under stress globally. Byju's has constantly come under fire for its aggressive sales tactics. It has been accused of pushing its products on families who cannot afford them. Mumbai-based Lido Learning, which provided live online tuitions in small groups of 6, closed down in February and asked its 1,200 employees to hand in their resignations. Before it ran out of funds, Lido had seen rapid growth and was on track to reach a $100 million revenue run rate by the end of the financial year.
So I think the edtech companies are under pressure to grow too fast, too soon. And, education is one of those fields where it takes time to build credibility. People come to you because of word of mouth, because of your reputation, because of what credibility you've built over the years. If you look at any of the top academic institutions in India right now, it has taken them decades to build this kind of credibility. They have given results. They have proven themselves over a long period of time. Investor pressure is definitely one thing that is playing a role in this. I think sooner or later, these companies will realize that, you can get some growth by spending a lot of money, burning a lot of cash. But if you want to build a sustainable business, then it takes time.
With increasing smartphone users and rising demand for quality education, there is no denying that the potential for growth in the edtech sector is huge. Higher education institutions are also focusing on creating online programs. India's edtech market is expected to touch $10.4 billion by 2025, led by K-12 and test preparation segments. Edtech startups in India raised $4.7 billion in 2021, with Byju's alone raising about $1.9 billion. Majority of the funding went to test preparation on online certification startups. As investors seek growth, major edtech firms are embracing the hybrid model to tap India's booming $180 billion education sector. Byju's is investing over $200 million to open 500 brick-and-mortar tuition centers in the next 12 to 18 months, on top of the existing 80. Last month, Unacademy launched its first offline experience center in Delhi.
There is a huge potential in online only programs, whether it's degrees or certification programs or even classroom training, classroom coaching and all, because India is a very big country, and other than tier 1 cities, most of the other people in India don't have access to top quality resources. So online is definitely the way to go, and there is a huge potential there. But I think what these companies are feeling is we are anyways doing everything we can on the online side, and we have almost unlimited funds to play with, so why not try the offline approach as well? So they are just doing everything they can to go after growth. This is driven by the investments that they've got, the investor pressure, and they're trying to go after every avenue of growth that they can seek. If I talk about our own experience, we at Manipal here, Jigsaw Manipal, with 15,000 students coming in last year, close to 30,000 students we are going to get in this coming year. This is still the tip of the iceberg. India has amongst the lowest gross enrollment ratios in the world, which means very few people are actually going for degrees. And so if online education can help increase this, can help make degrees more accessible to a larger number of people, then I think that market is infinitely huge. So I think anyone in the degree space is going to see a lot of action. There is going to be investments that will come into this space.
Expecting investors to temper their expectations for growth may not be a good idea. But edtech companies should realize that growth that comes at the cost of high cash burn may not be sustainable.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं? ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं? वो तो सबसे आसान है। तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Like the edtech firms, India's electric vehicle sector is also facing a moment of reckoning after at least 4 two-wheelers erupted in flames last month. Is it because a few companies are rushing too fast, overlooking the most crucial part in any electric vehicle, which is the quality of its battery? Our next report offers some insight. Four electronic scooters burst into flames in quick succession in as many parts of the country late last month. And the news spread like wildfire, with the visuals and video footage of the burning two-wheelers flooding social media platforms. The manufacturers on their part went into firefighting mode. They claimed that the battery-run two-wheelers were as safe as the vehicles that run on internal combustion engines. They also rejected the theory, which has been doing the rounds on social media platforms, that such vehicles were not fit to withstand Indian conditions like the heat, potholed roads and heavy loads. But why did these scooters catch fire? The only common link between these scooters is fixed lithium-ion batteries. In December last year, e-scooters were banned from the public transport network in London over safety reasons. Officials there said that hurriedly packed or defective batteries had led to a spate of fire incidents in such scooters. Experts point out 3 main reasons for battery failure which led to fire. The first is their improper packaging, then the bad quality of cells, and the third is improper battery management system, which determines how the battery should accept charge and how it discharges. It works like the brain of the battery. A lithium-ion battery is composed of hundreds of lithium-ion cells, and a deformity in one cell leads to a chain reaction which engulfs all other cells. Also, densely packed cells will have less room to breathe and may also cause problems. Experts also pointed out that the overcharging may lead to formation of crystals on the surface of anode. And if it grows larger and goes on to touch the cathode, it will cause a short circuit. That's why most e-scooters now come with an auto cut-off system.
So what we believe is, firstly, the battery designing has to be as per the Indian environment and has to focus on certain standards on the thermal runway, most importantly, the thermal management within the batteries. Secondly, yes, through the tech, this can also be solved. As in the battery swapping space, what we are doing is we have a IoT device within the battery, which gives us through which we can do predictive analysis on the how the battery is behaving, how it's performing, and we can say that in next 20-25 days there could be a deterioration on the battery level. So that's one way. There could be probably the right type of alerts on the temperature rise of the cells. So these are few measures through which this can be avoided, such situations. Last year close to 1.6 lakh of two-wheelers sold in India. Now out of that, 2 or 3 such instances cannot be used as generalizing the whole the sector. But and also with the the demand side and the rising fuel cost, electric two-wheelers definitely make much more sense for the end user.
Meanwhile, Arun Shreyas, co-founder and CEO of Race Energy, attributes these fire incidents to the urgency of a few companies who skipped proper validation and testing. Suhas Rajkumar, founder and CEO of Simple Energy Private Limited, believes that the fire in e-scooters may turn out to be good news for the industry. He told a national daily that these incidents will make people realize the importance of R&D and safety standards of the battery itself. The government too has launched an investigation into the incident of fires. Center for Fire, Explosive and Environment Safety, which comes under Defense Research and Development Organization, has been tasked with the responsibility to find out the cause. In India, all vehicles should conform to Central Motor Vehicle Act standards. According to a business daily, the government can also ask Ola and Okinawa to recall their two-wheelers. The manufacturers too are trying to douse the flames and get to the root of the problem before it spooks the buyers. They want to present e-scooters as a realistic personal transportation option. The government is also working to establish standards for battery swapping services for electric vehicles. By 2030, it expects electric scooters and motorcycles to make up 80% of the total sales of two-wheelers. Right now, it is just 2%. But these recent incidents of fire may cast a shadow over such a plan. Niti Aayog has joined hands with the Bureau of Indian Standards, Department of Science and Technology for detailed technical standards for batteries.
On the technology of the batteries, there should be certain standardization on the the IT infra around it to alert the end user, prevent such situations. So that measures not only from the government side but also from the industry side. The industry should take, be it an OEM, be it an energy operator, be it a battery manufacturer.
Incidents of electronic scooters catching fire are clearly not good for their makers and the government too, which wants to shift the country away from fossil fuels. The companies on their part should ensure that the report of probe into these incidents are taken seriously and made public too. It is said that the image of Tata Nano took a hit due to similar reasons.
यार
मत पूछ यार, फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
The sales of electric two-wheelers saw a steep 132% rise in 2021 over the corresponding year 2020. Meanwhile, India Inc. is all set to start the Q4 earnings season. IT major TCS will kickstart the season with its results later today. Persistent high levels of attrition and high cost in relation to muted price increase have continued to worry the sector. So, will the sector's performance be marred by the geopolitical risks in Q4? we bring you a report on what analysts expect.
A seasonally weak quarter could prove to be an overhang for Indian IT sector's performance during the January-March period. While demand is likely to see decent growth on the back of digital transformations and the cloud shift, analysts anticipate margins to be under pressure due to supply challenges. Moreover, companies may bake in potential impact on demand from Russia-Ukraine war and elevated inflation in the United States and Europe, which raise concerns about the sector's near to medium-term performance. Ashish Das, research analyst at Sharekhan by BNP Paribas, for instance, expects the sector's revenue to moderate sequentially given the high base of third quarter and weak seasonality.
Increasing IT spends on transformation initiatives across the industries is expected to maintain strong demand momentum in the medium term. During Q4 FY 2022, Wipro and Tech Mahindra are expected to report leading organic constant currency revenue growth of 3.2% quarter-on-quarter and 2.7% quarter-on-quarter respectively. On reported basis, Tech Mahindra is expected to lead among top 5 IT services companies with a constant currency revenue growth of 5.2% on Q1Q in Q4. CC revenue growth of TCS is expected to remain at 2.4% Q1Q, led by higher spending on digital transformation initiatives. We expect EBIT margin of Indian IT to remain flat to negative sequentially, owing to slow revenue growth, higher attrition, rising travel expenses. For TCS, we expect EBIT margin to remain flat as it is well positioned to offset the margin headwinds such as higher costs to backfill attrition. We expect deal TCVs of TCS to remain stable on a sequential basis at around $8 billion in Q4 FY 2022.
On an aggregate basis, analysts are expecting fourth quarter revenue growth rates in the range of 1.5 to 5.3% constant currency quarter on quarter for top tier players and 2.2 to 8% for mid-cap companies. That apart, margin contraction may also extend during this quarter as employee costs have continued to sting. According to ICICI Securities, margins of IT majors could contract on a quarter-on-quarter basis despite the industry continuing to add record number of freshers. The attrition would continue to be high, hence costs to backfill attrition and those related to retention etc. are likely to put pressure on margins. Those at Prabhudas Leeladhar meanwhile expect aggregate margins to decline by 40 to 80 basis points quarter on quarter and 150 basis points year on year due to headwinds from aggressive hiring, lateral recruits at higher costs and rollout of wage hikes. From a long-term perspective, Gaurang Shah, Senior Vice President, GeoJit Financial Services, sees the IT sector as a relatively safer bet as it remains insulated from higher crude and commodity prices.
Our sense is that the performance for the fourth quarter and for the quarters to come by, including this financial and many more to come by, it's one of the relatively attractive sectors for long-term investment. The other factor that will work out positive is being a services sector, IT sector like banking and finance and telecom services does not get impacted by higher crude oil prices. So there is some amount of flight to safety investments also that will be attracted towards services related sector like IT. In terms of the numbers, crucial to see what is going to be the constant currency growth and dollar revenue. Along with that, attrition rate is something that is very, very crucial. And of course, the commentary from the management for this financial year as to how the growth is going to be. But overall, we at GeoJit remain extremely positive, and in fact, we've been advising investors from a long-term point of view to buy into some of the mid-cap and large-cap IT stocks.
Against this backdrop, TCS, which will announce its results later today, will remain on investor radar. March quarter results of small-cap firms like Birla Tyres, Kesoram Industries, and gaming and hospitality company Delta Corp would also hog the limelight. On the global front, investors will continue to monitor geopolitical developments around the Russia-Ukraine conflict and key commodity prices.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है Investing made easy and reporting with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
After the markets, let's move on to banking. The Reserve Bank of India imposed a fine of 93 lakh rupees on a prominent private lender last week for rules violation, including that of Know Your Customer or KYC. But what is KYC? Our next report offers some insight.
Banks and financial institutions are required to follow certain customer identification procedures for the opening of accounts and monitor transactions of suspicious nature for the purpose of reporting them to appropriate authorities. These guidelines are in the form of Know Your Customer, Anti-Money Laundering, and Combating Financing of Terrorism regulations. The objective of these guidelines is to prevent banks and financial institutions from being used intentionally or unintentionally by criminal elements for money laundering or terrorist financing activities. KYC procedures also enable banks to understand their customers and their financial dealings better, which in turn helps them manage their risks prudently. Banks should frame their KYC policies by incorporating 4 key elements: customer acceptance policy, customer identification procedures, monitoring of transactions, and risk management. Every bank should develop a clear customer acceptance policy, laying down explicit criteria for the acceptance of customers. No account shall be opened in any anonymous or fictitious name. Banks cannot open an account when it is unable to verify the identity or obtain required documents. A bank can also consider closing an existing account under similar circumstances. It is important to note that the adoption of customer acceptance policy and its implementation should not be too restrictive, resulting in the denial of banking facility to people who are financially or socially disadvantaged. Next comes customer identification, which means undertaking client due diligence measures while commencing an account-based relationship. This includes identifying and verifying the customer on the basis of one of the officially valid documents. For opening accounts of individuals, banks should obtain one certified copy of an officially valid document containing details of identity and address, one recent photograph, and other documents pertaining financial status of the customer as may be required. Documents accepted as proof of identity and address are passport, voter's ID, driving license, Aadhaar, Narega card, and PAN card. Banks are allowed to adopt simplified measures and accept certain other documents in respect of low-risk customers. Continuous monitoring is an essential element of effective KYC procedures. Banks are expected to closely examine the transactions to ensure that they are consistent with the customer's profile and source of funds. The extent of monitoring will depend on the risk category of the account, with high-risk accounts subjected to intensified monitoring. Banks should exercise continuous due diligence with respect to business relationship with every client and closely examine the transactions in order to ensure that they are consistent with their knowledge about the clients, their business, and risk profile. The Board of Directors should ensure that an effective AML-CFT program is in place by establishing appropriate procedures and ensuring their effective implementation.
यार आइसक्रीम खाएं? नहीं यार, कुल्फी।
We Indians disagree on everything, but we agree. SBI is the banker to every Indian.
अरे SBI contactless debit card? I agree.
SBI is the banker to every Indian.
The central bank is mulling amending Know Your Customer anti-money laundering norms to plug some loopholes after a spate of frauds in digital lending activities. Well, that's all we have for you today. We will be back with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.